So I want us to start with this question of December 2014, question 3. December 2014, question 3. December 2014, question 3. So in that question, December 2014, question number 3. With reference to performance evaluation decisions, explain the following terms. 1 is responsibility center, number 2 is investment center, and number 3 is responsibility accounting. I think those things we have them in the notes, but maybe quickly we can make short notes. Write this, like this. A responsibility center is an individual part, of a business, headed by a manager, who is held responsible for the performance of that part. Is held responsible for the performance of that part. The next one is an investment center. An investment center is a center for which the manager is responsible in relation to capital employed or invested in that center. In relation to capital employed or invested in that center. Okay, the third term is responsibility accounting. Responsibility accounting is a system based upon the identification of individual parts of a business. which are the responsibility of a single manager. Which are the responsibility of a single manager. Okay. Part B says WMT Limited is a manufacturing company which has 3 divisions, namely X, Y, and Z, distributed in 3 countries. The company does not allocate corporate head office costs or interest on long-term debt to the divisions. The summary of the results of the company and its divisions for the year ended at 1st of October 2014 are provided below. So we have the operating income, we have the variable cost of the head office, interest on long-term debt, fixed cost of the head office, income tax or income before tax, we have taxes, income after taxation, the average book values, we have the current assets, we have the non-current assets. We are required, using the return on investment criterion for each division and the organization as a whole, advise the management of WMT on the most profitable division. The most profitable division. So we can handle that this way. We are told to use return on investment. Return on investment. So here we will have details. Now, return on investment, we know, is given as income. You divide by assets. You multiply it by 100. And that gives you return on investment. And then we are told to rank. So we are going to prepare a rank. We're going to see which one is more profitable than the others. So if you start with division X, you can see the income. The income is 720. Now this one, you divide by the assets. The average assets are 3,000. Yeah, 3,000. Multiplied by 100. %. Then we go to division Y. Division Y. Division Y, we do the same. 900 over 6,000. Over 6,000 times 100. %. 15%. Then we go to division Z. Division Z, we have 1440. 1440. You divide by the assets, which are 9,000. times 100. We have 16%. Then we have the company. We have the company. Now the company, the profit that you can see there is that 60. But now there are some additional expenses that you need to less. There is the variable cost of the head office, and there is the fixed costs. So we have the 240, and we have what? 360, yeah? Can you see those costs that are in the head office? But we are not going to charge interest on debt because these other interests, these other income that we have used, these are before interest. Yeah, they are before interest. So we will not include it. Then you divide by the total assets of the company. The total assets of the company are 19,500. 19,500 times 100. %12.62%. 12.62%. So with that now, we rank. So ranking will be like this. This is number 1, this is number 2, and this is number 3. Obviously, you don't rank the company. You don't rank the company. You okay with that, eh? Okay. The next thing, we are told compute the residual income for the division, assuming that they require 10%. Assuming that we require 10%, you are told to compute so we will again have the rank here. We have residual income here, which will be arrived at cost of capital minus income so this is residual income. Residual income. Residual income. So sasa division X. Division X is given as 720 minus 10% of the asset. The assets are 3,000. Assets are 3,000. For 20. Then we go to division Y. Division Y, the profit is 900 minus 10% of 6,000. $300. Then we go to division Z. Division Z is 1440 minus 10% of 9,000. So we are at ngapi? 540. 540. Then we have the company. Company, the profit what tumesema ni 3060 minus 240 minus 360. Yeah? So this you minus 10% of 19,500. $30,10. 5K. In terms of ranking, this is number 1, this is number 2, and this is number 3. 5, 10, or 5. Oh, 540 go up at 2. Yes, according to Mukami good. So here goes up. Higher. The next question is, assuming that there is an asset available to division X, which costs 300 million, and which has an annual profit of 60 million. Advise the manager of division X on whether to undertake the project, commenting whether the decision is in line with the overall objective. The overall objective. So I told you when you are appraising new projects, so new projects in division X. New project in division X. You simply compute return on investment. Return on investment of the project. Return on investment of the project, which we know it is income. Income is 60. And the investment is what? 300 times 100. times 100, 20%. Then you also need to bring the return on investment of division X. Return on investment of division X. We had computed to kapata what? Return on investment for division X, we had gotten 24%. And then there is something else required to bring. Required rate of return, required rate of return is 10%. Those are the three things that you need. So you will have the appraisal method, the decision, and the explanation. If you are using return on investment, I told you what you do. You compare the return on investment of the new project and the return on investment of the division. And if the project has a smaller return, you reject it. So here we are going to reject. And the reason is 20% is less than 24%. Because it has a smaller return. They will destroy value. The next method is residual income. Residual income. If you are using residual income, I told you you compare the return on investment of the project and the required rate of return. So here we will say accept. We will say accept, and we are accepting because 20% is greater than 10%. It's greater than . So I think we are okay with that. So I think we are good there. The next question is May 2012, question 5. May 2012, question 5. May 2012, question 5. So the question says, part A, explain why it's preferable, why it is preferable between managerial performance and economic performance. I think that, what does your paper? Huh? I don't know what was the original question, but maybe the question could be about why we need to differentiate between managerial performance and economic performance. And this one we discussed in the notes, and tukasema managerial performance is where you appraise the manager as a person. And economic performance is where you look at the performance of the division. The performance of the division. So I think that is okay. So part B, Chemical Limited manufactures a variety of chemicals. Yeah? Okay, is someone talking? Okay, a variety of chemicals. Let me check from the original. This question had errors right from the beginning. In terms of the grams, I should have the the original should have read this way for part A. Explain why it's preferable to distinguish between managerial performance and economic performance. Why it's preferable to distinguish. Preferable to distinguish. Then, Chemical Limited manufactures varieties of chemicals. One of the chemicals is branded Marisa and is manufactured using 3 types of ingredients. I think that one I'll have to read the updated one because I changed. Those grams were not agreeing in the original paper. So I adjusted. So we have ingredient PP, 30 grams at 0.8 per gram. That is the one giving us 24 shillings. KK, 25 grams at shillings 1.2 per gram. That is the one giving us 30. And 15 grams at 1, that is giving us 15. And the total is 69. Additional information is that during the month of March 2012, Chemical Limited manufactured 115,000 units of Marisa using that 500 kilograms of PP, 2,000 kilograms of KK, 19,000 kilograms of MM. Chemical Limited has used activities-based costing to allocate its overhead for a number of years. One of its main overheads is a machine setup cost. During the month of March 2012, the following information was available in relation to setup costs. Total number of units produced, total number of setups, total setup costs. So we are given that. Calculate the following variances of ingredients in Marisa, material usage, and so on. So we can start. The first one is material usage variance. I think because we have the formulas, we can use initials. We have to write in full. Okay, so material usage variance is given as standard quantity minus actual quantity, you multiply by the standard price. Standard quantity minus actual quantity multiplied by the standard price. So according to our structure up there, you can see the standard ingredient usage and cost of 1 unit of Marisa was supposed to, ukikuta kwa PP, 1 unit was supposed to take 30 grams. 30 grams. And the actual production was 115. 115. Now this one, confirm these prices. The price is per gram, It's per gram. So if it is per gram, so you multiply by that minus the actual quantity. The actual quantity that was used was that 500 kilograms. Now 1 kilogram has how many grams? So this one must be multiplied by what? 1,000. And the standard price per gram is 0.8. 25,000. Favorable or adverse? Adverse, negative. Then the other one is KK. KK, we were supposed to use 25 grams. So it's 25 times 115,000. Minus, we actually used 2,000. So times 1,000. And the cost per gram was 1.2. 1.2. $1 million? 1,050,000. Favorable advance. Favorable. The next one is called MM. MM, we were supposed to have used 15 grams multiplied by 115 minus, we actually used what? 19,000 kilograms. Is it reading 19,000? Times 1,000. 19,000 or 1,900? I know the question had errors from the beginning. It is appearing, what is appearing in your book? 19,000. Let's go with it. Let's go with it, but it's weird. Let's go with that. And the cost per gram is 1. 19 million? 17 million. 275,000 advance. Okay, let's go with that. The issue is that the computation, the figures are weird. The original question had 1900, but now the table there is also not agreeing with the original question. Okay, let's proceed. The next is what? Materials mix variance. Materials mix variance. So materials mix variance is given as revised mix minus actual mix, you multiply by standard price. You multiply by standard price. You multiply by standard price. So we start with the PP. And I told you when it comes to mix, what you do, you get these originals, standards, one of them. So give me 30 plus 25 plus 15. 30 plus 25 plus 15 is 70. So that means PP was to bring 30 in a total of 70. 30 in a total of 70. Then add these actuals, that 500 plus 2,000 plus 19,000, 24,500. 24,500. Minus that 500 multiplied by the standard price. But now, look here. This standard price is per gram. It's per gram. But what we have done here is our kilos. So we must either convert this to kilos, to grams. We convert this to grams, or we convert this to price per gram. And the easier is to multiply here by 1,000. As the easier way. $5.6 million. Favorable advance. Favorable. Twende kwa KK. KK was supposed to bring 25 in a total of 70 times 24,500 minus it brought 2,000. 0.1.2 times 1,000. $8.1 million. Favorable. Then we go to MM. it is 15 out of 70 multiplied by 24,500 minus 19,000 multiplied by 1 times 1,000. That it million. Advance, Okay. Where was the next one? Inaitwa material yield variance. Material yield variance. So material yield variance, we say the standard yield minus actual yield. Standard yield minus actual yield, you multiply by standard material cost per unit. Standard material cost per unit. Standard material cost per unit. And I've been telling you that when we talk about the yield, we are asking ourselves, for every 1 unit to make up, how many units did we get out? So our output was 1 unit. That is what we got after we input 70 grams. After we input 70 grams. So if you multiply this by our input of 24,500 times 1,000, because this is 24,500 work kilos, so you multiply by 1,000 so that they go back to grams, because this 70 is grams. Now you minus what we actually got. What we actually got was 115,000. What we actually got was 115,000, and then the standard material cost needed to go to the add up in 69. Because you see 69. $10,215,000. 215,000 is positive or negative. So come on, positive here we are bash. $215. Kama ni positive kumaanisha actual yield ni kidogo. So when you get a smaller yield to the actual, that is bad news. Aya, huyo mwingine anaitwa expenditure variance. Now these are the activity-based variances. Maybe we need to specify the activity-based variances. Activity-based variances. There are usually just 2 of them. One is called expenditure variance. Expenditure. Now, expenditure is given as a standard rate. Standard rate. Obviously, standard activity rate minus actual rate. Actual rate. You multiply by actual activities. You multiply by actual activities. So there is only one activity here, which is called setup. And just like you should remember with the kuna swali tulikuwa tunajibu juzi kwa standard now. Forgetting. The one we are talking about standard, then you are taking the values for the budget. They are planning and efficiency. They are planning and efficiency. So the budget expenditure was 21,200. Now this one was supposed to cater for how many setups? 72,000. So that is the standard rate. But the actual amount that was paid was 24,500,000. And this one was supposed to cater for 85,000 setups. And the setups are 85,000, the actual. Uh-huh. 778. Negative or positive? Positive, eh? So come on, positive, that is given more. Because in kumaanisha, the actual rate is smaller. Yes. Huyo mwingine anaitwa efficiency. Efficiency is standard activities minus actual activities you multiply by standard rate. Standard rate. So the standard activities, you get the number of units that were to be produced, 370. Sorry, not 370. You argue these are the way around. Okay? We are looking for activities. And the argument goes like this. For us to produce 370,000 units, we required 72 setups. So 1 unit required how many setups? So it will then be, we had 72,000 setups. Now these were to be enough for 370,000 units. So this, the answer you get here, this one, it will tell you 1 unit required how many setups. You multiply by the actual units that we produced, which were 450,000. Then you minus the actual setup that were used. The actual setups are 85,000. And the standard rate is 21,200,000 You divide by 72. Seven and 6. Positive or negative? So come on, positive, that is equal to what pass. So I think we are okay with that. And if that is true, so that tells you now these variances. They are just two. They are just two. Una expenditure na efficiency. And the formulas remain. They are just two. And if they ask you to get the total, you just add this like this. You just add those two. The next question is May 2015. Question that should be question 2B. I can solve the whole of it. Am I your part A we solved in class? Question 2. Oh, I can see it somewhere. No, I give you as an assignment. So let's solve the whole of it. May 2015, question 2. So it says that GC Limited is evaluating the assembly cost of producing large LED television sets that target high-end customers in the entertainment industry. The company has just received an order for 8 new television sets. The estimated costs are as follows. We have direct material, direct labor costs, 300 per hour. Indirect manufacturing costs are predicted using 2 separate cost functions, each with its own cost driver as follows. So we have equipment related, we have materials handling, A running effect of 85% is expected to occur. The running index for an 85% running curve is that GEC Limited charges a profit margin of 33 1/3. So you are told to get the invoice for the 8 television sets. So that question is the use is pricing and running curves. And I've always told you the first thing is to know, are you using the total approach or the average approach? That question A. So we will say using running curve. Using running curve, total method. Using running curve, total method. The formula is y is equal to ax b plus 1. B plus 1. So we now need to identify these items. So B, the examiner, or first of all, we know it is given as the log of R multiplied by the log of 2, and this is the log of 0.85. You divide by the log of 2, and the answer we are given is minus 0.2345. You can confirm. Confirmed, good. Then B plus 1 is minus 0.2345 plus 1. 0.7655. Then H, it is the number of units that we're looking for. So our question entails how many units? 8. Then A is the time taken for the very fast. A, time taken to make the very fast. We are told it is 2,000 hours. Then, ukifika hapa, you need to know whether it's continuous or specific. Or in simple terms, is the first one part of these 8? In other words, are you told they had made some others? Kuna mahali unaona kama walikuwa wametengeneza others? No. So kama hauoni, that means you just apply the formula straight. So the formula then will be y is equal to 2,000 times 8, you raised to power 0.7655. Hmm? 98. 26. Exact. Rounded. Rounded, eh? Okay. Yes, Christine, I can see the figure. So we are told now to prepare the quotation for the 8 television sets or the invoice. Invoice is the word they use in financial reporting, but in management accounting we use the word quotation. For 8 TV sets. For the 8 TV sets. So tunaifuata tu kuanzia huko juu, direct materials costs. So direct material costs, you are told it is 400,000 per TV. So when you multiply by 8, that gives us how much? 3.2 million, eh? 3.2 million. The next one is direct labor. Direct labor costs. Direct labor costs, 1 hour inalipwa 300. Na tume establish it was 90 what? 98.26. Those are the hours that we required. $2,947,800. Haya, hiyo ingine ni equipment costs. Equipment costs. Equipment costs. Equipment cost according to information 4 bullet 1, it is 120 per hour. So it is 120 times 98.26. $1,120,000. Next is handling costs. Handling costs. So the handling cost is 50% of direct material cost. So it is 50% of 3.2 million. That will be 1.6, eh? 1.6 million. I think that is all. So sasa hiyo ikifika hapo, the figure you get is called total costs. $926,920. Then you bring the profits. Now this profit, we are given margin. And I told you margin is in terms of the price. Now we have the cost. So you must convert it to markup. So that 3% is just that. I don't know whether you will be able to get that. Eh? It is that 3 and that %. So to convert it to markup, what you do, you subtract. You subtract the numerator. When you subtract the numerator, that now becomes the markup. Then you multiply by 8,926,920. Give me the figure and round up or down appropriately. Get that and quickly read part B of the question. I can solve part B of the question.
Sorry.
4 umepata ngapi hapa? 4 million. 460. Kuja 13 million. 390. 380. Okay, good. So I believe you have read part B. So you just solve straight. Sisters. You should consider hiring me next time. Yeah? Sini sawa? No, nitafanya like 4 or 5 points. Nipate 93, 95. Good. So material price variance. Material price variance is equal to standard price minus actual price. You multiply by actual quantity. So we start with the material F. Material F, ukiangalia hapo juu kwa standard, a kg was supposed to go for 400. But down there in the actual, it ended up costing 425. And the actual kilos that were bought, they were 1680. $42,000. Advance, eh? We go to material G. Material G, up there, it was supposed to cost 300. But down there, it ended up costing 280. And the actual kilos was 1650. That 3,000. Favorable advance. Favorable material H was supposed to cost 600. And it ended up costing 640. And the actual kilos were 870. $34,800 advance. Let's go to material usage. Materials usage variance is standard quantity minus actual quantity. You multiply by standard price. So we go to F. Now, when we talk about the standard, I've been telling you, you must first of all go back to per unit. And the per unit, you argue like this. If you look at the standard, to make 15 kilos of F, 12 of G, and 18 of H. That should be what? It is 8. Okay, my paper is not 5. Because they should go to 35. So after 35, we lost 3, the normal loss, the standard loss. We took back in at 32. So the argument was every unit of the output should have used how many? And the answer is 15 were enough to make that 2. So 1 unit of output was taking 15 out of that 2. Now multiply by the actual units that were produced. The actual units that were produced is 3648. Yeah? Can you see that? 3648, the kilograms. You compare with what we actually used, 1680 at the starting price of 400. at a starting price $12,000, favorable or adverse? Positive or negative? Favorable, positive, eh? Okay, then for G was supposed to bring 12. So that's 2 times that is 648. You minus 1650 at a starting price of 300. With the 4,600 advance. H is 8 in a total of that 2 times that 648 minus 870 at a starting price of 600. Hmm? 25,200 favorable advance. Favorable. The next is materials mix. Materials mix variance is revised mix minus actual mix. You multiply by the starting price. You multiply by the starting price. F is the mix. I've just said a while ago is about the proportions. So F was to bring 15 in a total of that 5. Was to bring 15 in a total of that 5. So add these three, the 1680 plus the 1650 plus 870. You're to do the actual total ilikuwa ngapi? 4200 minus the actual mix. The actual is 1680. 1680. You multiply by the starting price of 400. $48,000. Favorable advance. Favorable. Positive, eh? Yeah, now you okay? 48,000 favorable. Twende kwa G. G was supposed to bring 12 in a total of that 5. So multiply by 4200 minus 1650. The starting price is 300. $63,000 advance. Then H is 8 out of 35 times 4200 minus 870 at 600. $4,000. Favorable or adverse? Favorable. Then materials yield variance. Materials yield variance is standard yield minus actual yield multiplied by standard material cost per unit. Standard material cost per unit. So I've told you a while ago that when you're talking about the yield, tunajiuliza for every one input, how many did we get out? And you begin by what you got. We got that 2 out after inputting 35. After inputting 35. So if you multiply by the total input of 4200, that tells you what you should have gotten. You compare with what you actually got, which was 36.48. 36.48 times the standard material cost per unit. If you go to the standard card, you can see the 6,000 plus the 3,000 plus the plus the 600 plus 4,800. Can you see those figures in the standard card? Now that is the total cost of the input as per the standard. And this one was to give us that 2 units. You remember the question tulijibu juzi ilikuwa na 10% loss. You remember that? Tukasema hapa it was 1 minus 0.1 tukapata 90. So the same thing hapa tunasema 35 minus 3 equals to 32. Into 6,400. Favorable or adverse? Into 6,400. Positive or negative? Kama ni positive, that is adverse. Hiyo maneno inastahili. Hiyo kabisa. But I told you if you're not very sure, just leave it. Finally, labor cost variance. Labor cost variance, this must be the total labor cost. So this one we say it is the standard labor cost minus actual labor cost. Standard labor cost minus actual labor cost. Sasa, the standard will be like this. Utaenda hapo juu kwa standard. Upate, we were supposed to spend 4,000 plus 1,200. Can you see that? Now this one was supposed to be enough for that 2 units. That 2 units. So you multiply now by the actual units, 36.48. That will give you the standard labor cost. You minus the actual labor cost. The actual, unakimbia hapo chini kwa actual results, where unapata 6,000 ikiwa pamoja na 151,200. 151,200. 194,400. Yes, Christine can see that. Favorable or adverse? Negative, eh? Good. I have 12 minutes. And I think because I also came late, almost 12, 15 minutes. Maybe we can do one more. So the next is June 2013, question 2B. June 2013. June 2013, question 2B. The question is on reconciliation. Is profit reconciliation. Statements. We have details. We have the formula. We have the workings. And we have the amounts. Because these are supposed to be assignment questions, you should have read and attempted. And now that we are constrained by time, just quickly solve. So the first thing, I gave you the format. Tukasema format. You begin with budget profits. Budget profits. And the formula for the budget profits is budget revenue minus budget costs. Budget revenue, you minus budget costs. So what you can see, can you see the standard selling price? The standard selling price in the 1840. So 1840 multiplied by the budget units according to information 2. The budget production was for 10,000 units. You can see that, eh? So this one will give you the budget revenue. You minus the budget costs. The budget cost is direct material 864, weka hiyo kwa calculator. 864 plus the direct labor 225 plus the variable overhead of 75. 1164. So these 1164 should be multiplied by the units 10,000 Then we add, now that was variable cost. Then we add the fixed cost. According to information 1, the budget fixed cost was 1,700,000. So that now you have the budget revenue minus the budget costs. $5,060,000. So once you have now, you bring the variance. You bring the variances. And the variances, I have been telling you, you bring sales price first. Sales price. And sales price is given as budget selling price minus actual selling price. Budget selling price minus actual selling price. You multiply by actual units sold. Actual units sold. So the budget price, we already know it is 1840. Minus, remuka hapo kwa actual results, information 3. Oh, information 4. It is 1840. And the units that were sold, according to information 2, they were how many? 9,000. So that gives us the variance of 0. Huyo mwingine tukasema anaitwa sales volume. And sales volume is given as budget sales unit minus actual sales units. You multiply by standard contribution margin. Standard contribution margin. So according to our budget, we want to sell 10,000. But we ended up selling 9,000. Standard contribution should be the selling price, the budget selling price of 1840 minus the variable costs. The standard variable costs we had earlier on found to be 1164. 1840 minus 1164. 76,000 favorable or adverse. It's adverse because we sold fewer units. Yeah. Haya, huyo mwingine ni total material costs. Total materials costs. So hii tukasema it's given as standard material costs minus actual material costs. So sasa the standard unaangalia hapo juu, 1 unit was supposed to cost us 864. So you multiply by the actual units that were produced, 9,000. That gives you the standard. Then ukipia hapo chini upate that the actual was 8,288,000. 8,288,000. 512. Favorable or adverse? Negative or positive? That is adverse. Haya, huyo mwingine ni total labor costs. Total labor cost. So total labor cost is standard labor cost minus actual labor cost. Standard labor cost minus actual labor cost. So ukikibia hapo juu unapata 1 unit was supposed to be 225 multiplied by 9,000 minus the actual down there 52,000. Hmm? 27,000 advance. Sindio? Haya. Total variable overheads. Total variable overhead costs. Overhead costs, which we say is standard variable overheads minus actual variable overheads. Standard variable overheads minus actual variable overheads. So the standard is 75 multiplied by 9,000 minus the actual of 700,000. $25,000. Favorable or adverse? Adverse. The last one is fixed overhead expenditure. So this one tunasema is given as budget fixed overheads minus actual fixed overheads. Budget fixed minus actual. So our budget was 1,700,000 minus the actual turned to be 1,680. Hmm? 20,000. Favorable advance. Favorable. Then we now get the actual profits. The actual profits. And the actual profits is given as the actual revenue minus actual costs. So the actual revenue will be 1,840 times 9,000 minus add all those costs, the 82, 88, 2058. Add them. These are the costs, the actuals, the 82, 88,000 minus 52,000 minus 700,000 minus 68,000. 12, 17. The profit. That's 840. 3,840,000. Eh? So you can reconcile. I told you you get the budget profit, you add the deliverables, you less the advance, and you should get the actual profit. The budget profit and the deliverables less the advances. Check whether it agrees. See, so the only variant that we have not put there is the overheads volume, because there were no stocks. There were no stocks. So now, based on that, on your own, now you can add November 2015, question 5. I hope it will not become difficult when I'm away. So that now, going by the guideline I was given by Adam, we are through with the performance measurements. We are through with the standard costing and variances. So next time to tukutana ni budget now. Has it reconciled?